Sandeep Bhatia is with us, Head of Equity India and Country Head India at Macquarie Group. Sandeep, good to have you with us here. Thank you very much for your time. You know, a bit of a confusing time, especially if you kind of connect what's happening to global macros, right? Bond yields and the consequent damage that could inflict. Do you think this is a bit of a tactical move we've seen on the upside? I mean, yields, not bond prices, but the rally in yields and this pullback over the last 2 days. Where does the Macquarie Group, I mean, your sort of strategists, etc., come in? What's going on?
Yeah, I agree. Market has been all over the place. Yields coming off a bit. The message from the Fed when they last spoke was it's going to be data dependent. Data has not worsened, but it's not improved in terms of significant slowdown in the economy, which is would be considered an improvement that the economy is actually slowing down. So I think the Fed on the margin will still be looking at data. The Fed rate meeting is on the 1st of September. The market is currently betting that there are no further rises. But I think this changes every week. So we will go closer to this and take a decision. But I don't think the Fed increase cycle has completely gone away. Even if it doesn't happen on 1st September, it can happen in the first quarter of next year. So we'll wait. As far as India is concerned, I think we will currently hold rates. We want to increase rates. So the strength in India should broadly continue. But the overall market strength will depend on if there's any significant changes in the Fed. And if the Fed continues to raise rate, it will put pressure on all markets, including India.
Oh, okay, all right. But, you know, we have a lot of big events that are upon us over the next 6 to 12 months, right? There is the elections here in India. There's the elections in the US. Then, of course, the rates are rising across the system. Given all of this, do you reckon that the market could take a pause, take a breather before, you know, the next leg up? I mean, are we looking at some sort of a time correction, if not a price correction in the market?
Well, I think time correction is definitely the least that the market will see. There could also be price corrections. There are state elections, as we all know, before the final general elections. And state elections may not entirely be in favor of BJP. So to that extent, there would be some headwinds in terms of politics, which BJP may face. So there could be even a price correction. So I wouldn't rule out both a time and a price correction. As I said, the best case outcome would be a time correction.
If you ever see a price correction, Sandeep, what do you think? I mean, I recall when we spoke earlier this year as well, you said the markets are not very, very cheap. And, you know, if it dips, then you could be a buyer. But at current reckoning, well, we're still at 19,500, just 3% away from the recent highs. Not a buyer? Do you see much further downside from
Yes. Yes. So, yeah, I think the markets clearly have been much stronger than anyone anticipated. Earnings have been in line. I don't think earnings have been significantly superior or beaten expectations. It's another thing that our expectations are always very high, and therefore even to match expectations historically has been a challenge for the markets. But currently, I don't see that we are going to get any big positive surprises in terms of earnings. Therefore, the market corrections would be in the mid-cap, small cap sectors where there's been so much strength, and this is where the biggest risks lie. The large cap will continue to maintain. So the headline indices could remain unchanged, but there could be correction within them in the market.
You know, we're starting the second quarter earnings season. One space which has been sort of struggling in that sense has been the sort of consumption space, right? You look at volume growth numbers for most of these companies, especially staples, etc., but not just staples, even durables, flat to actually negative. Do you think, but this is a festive season, there's the World Cup, etc. You think things will look materially different and some interest may come back in that space?
So, you know, if I am a sales trader, I will say that the World Cup is a big event, but World Cup will be a maximum of two-month impact, right? 6 to 8 week impact. if you're looking at buying a stock, you probably want to look at earnings which is beyond the 6 to 8 month window. So yes, the festival season is on us, which is lasting a quarter from October to December, and the underlying strength of the economy, therefore, is a bigger factor than a World Cup or a quarterly performance. On that consumption front, I think we will still be moderate. So I wouldn't be I wouldn't getting overweight on the consumer sector. The strength lies in maybe more secular sectors such as the large cap private banks.
Okay, that was actually my next question. Where do you see the strength in this market? Where can you generate alpha or see outperformance? In the large cap private sector banks, I mean, it is sort of an overcrowded trade as well, right? Don't you think? And if not, what kind of potential do you see over the next 6 to 12 months?
True. Completely agree that it's an overcrowded trade. We've been saying that this for some time, that these are solid earnings and best ever balance sheet kind of environment that the private banks are operating in. But the whole market is an overcrowded trade. So either you step off this market or you continue to be in the safer parts of this entire market, which is the private sector banks. Other than that, if you want to take a short-term kind of trade, then probably in the cyclical sector, actually we are seeing signs of some improvement in the Chinese economy. So to some extent, in a 3 to 6 month horizon, you could actually see some of the ferrous metals perform. So we like Tata Steel. So these are parts which you can generate alpha in. But the reality is that this is an expensive market, and there could be bouts of corrections, and price correction, therefore, would be a safer point to enter the market.
Sandeep, there have been a couple of these themes that have worked out very, very well, whether you're looking at railways or defense. Do you think some of them have really run way ahead of themselves? Because as of current reckoning, well, they look good, the stories look good, but the earnings that people are looking at are not even FY25, it's like 26, 27. Your take particularly on both these two spaces, which have done very, very well.
So India definitely needs to scale up its capabilities, capacities, technology, the size of the firms, the quality and the quantum of both its transportation, railway transportation, also its defense sector. All these are decade stories, and these kind of earnings that the sizes of these firms currently are actually subpar, as we all know. And therefore, it's easy to ramp up these stocks when the theme has just started. So we are in the initial phase. If you talk to the bulls will tell you that, as I just said, this is a decade story. So don't look at valuations in the next 2 years. Look at what India can do in the next 10 years. And if you're a skeptic, you will say that this market has to correct, and this is an overcrowded and and a space in which everyone is looking in one direction. Therefore, this will fall the most. My 2 bits on this: we will see a correction. There would be some headwinds, both primarily, I think, on some of the politics which will happen around the state elections, and a market correction there would be a good time to enter the large cap sectors. As far as the broader direction of the market is concerned, it will actually settle only once we know where the US is headed. The US and the dollar have been remarkably strong. Everyone expected a recession by the second quarter. The recession has not happened. If the recession doesn't happen and the US actually has a soft landing, to that extent, India and India's exports and India's macro will actually do much better. So the best case outcome for the US is what is currently being priced in by the market, that there are no further rate rises in the US. The US has a soft landing, and and India can continue to grow at a very strong pace. So we will soon know this. I think at least by the next general elections, by March, April, these things will be clear.
Okay, I wanted your thoughts on one sector that is seeing some signs of a slowdown, right? The FMCG space. So if you look at the business updates from, say, a Godrej Consumer or even a Marico, they are talking about growth in low single digits, talking about a slowdown in consumption. Is that just, transient according to you, or is it some sort of a structural slowdown that we're looking at?
I think this is a slowdown which has been there for this year. markets try to wish it away, but it continues to come every quarter in terms of the commentary which comes from companies. I would think that at least for the next six months, at least till June, July next year, the consumer sector will be an underperform.
All right, we will let you go on that note. Thanks a lot for joining in. Sandeep, have a great weekend, and we hope to speak with you again very soon. That's the Macquarie Group talking about their view on the market. They say at worst, the market will go through a time-wise correction. So there's nothing really to worry. This is a structural growth story that India is looking at, and we could pile on some more weight over the course of the next many months. By the